Welcome to Commercial Real Estate Pro Network CRE PN Radio. Thanks for joining us. My name is Jade Aaron Gross. This is a podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's episode is sponsored by Building Insurance and Risk. When you invest in real estate, work with the insurance experts at Building Insurance and Risk. You will receive multiple coverage offers with a side-by-side coverage comparison. To learn more, go to buildinginsuranceRisk.com. Today, my guest is Jaspreet Baveja. Jaspreet is the Director of Fund Strategies, and he has a BA in Management Information Systems from Florida International University, and a computer engineering degree from Penn State University. He's been investing in real estate since 2013 and full-time since 2019. And in just a minute, we're going to speak with Jaspreet about multifamily investing. But first, a quick reminder, if you like our show, CRE PN Radio, there's a couple things you can do. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Jaspreet Baveja. Welcome to CRE PN Radio.
Thank you, Darren, for having me.
Well, I'm looking forward to our conversation, but before we get started, if you could take just a minute and share with the listeners a little bit about your background.
All right. Well, as you can see from my background, I am from the Bay Area, been here over 10 years. I am now full-time in commercial real estate. I started in real estate back in, just like Darren said, 2013, single family home, good old regular, bought it for primary residence, turned it into a rental. But my first intentional real estate investment was in 2017 out in Indianapolis. And since then, I have done private lending to the tune of about 300 plus transactions as a private lender, flips, buy and hold, Airbnbs, commercial multifamily properties where we are the general partners, the operators. And so got a broad breadth of information there on all of those different asset classes and investment strategies.
Now, it sounds like you've done a little bit of everything there. Private lending and single family and multifamily. That's great.
Yeah.
So let's ask the question: how did you land on multifamily?
Well, I think multifamily was brought to me as an option to diversify risk. I was an active investor, constantly doing active deals, flipping and buy and hold strategies. And a friend of mine at work said, "Hey, listen, I've got an investment opportunity from a friend of mine who I've known for eons, and they're an operator out here in the Bay Area. They do multifamily housing, but mostly actually student housing. And they're doing an apartment complex here in the Bay Area, walkable distance. Go check it out. Love to get you involved." Saw it, researched it, talked to another buddy of mine who had been in commercial real estate for over 10 years at the time, and said, "Hey, let's just evaluate, figure it out." And I ended up investing as a limited partner. Since then, I diversified into 7 other limited partnerships, but constantly came back to multifamily as one of those core asset classes that had nowhere to go because people always need a place to live. And especially the more value add component of, hey, listen, this is a pretty badly managed or a pretty badly maintained asset in a up and coming area where people are changing, demographics are changing, jobs are growing, and there's a lot of value to be added. Let's focus on those where people want to be. And yeah, it's just been a class that I've loved since then.
Got it. And have you invested primarily as a limited partner then in syndications, or how have you inserted yourself in these?
Yeah, so I started off as a limited partner, like I said, in about 7 or 8 transactions. But since then, I have transitioned to the general partner side. So Fairwinds Capital Investments, where I am now, is a company where we are operators. So we are the ones that are the lead sponsors. We're going out and finding the deal, putting the EMD down, negotiating the prices, and figuring out the loans, signing on the loans, raising capital, doing the actual asset management. So we are the lead sponsors at Fairwinds Capital Investments for multifamily investing.
Gotcha. And as such, do you have a particular asset or an investment strategy that you guys employ?
Yeah, the value add strategy, like I was talking about, where up and coming neighborhoods where assets are not as well maintained, their property management isn't really doing as good. They aren't keeping up with the rental increases. They aren't keeping up with amenities being brought on. Let's say package lockers are a big thing now because everybody's ordering online. They would like to have a dedicated spot where they can go and have their packages delivered away from theft and have some level of credibility. Okay, the package was delivered. It's going to be here on site, safe, ready to receive it. Or providing areas where, let's say, the washer dryers have cards or phone Bluetooth apps, things of that nature, where it's just getting easier and easier to leverage amenities that may already exist but are not as comfortable and not as up to date. Let's say having smart thermostats, smart locks, and one fob or one app to go from the main door of the building to the elevator to your actual apartment unit, all of those being under one management, right? Or to the pool access or anything of that nature, just making it easier and better for our residents as we enter this 2022, 2023 year. We want to make sure that our amenities reflect the time period that we're in, have better flooring, better appliances. And so that's our game plan, is to be in those neighborhoods that are seeing the change, seeing the transitions, and identifying assets that need that kind of work, pricing it accordingly, and then going in and value adding to the property, to the tenants, to the residents, and of course to our investors as well.
Got it. And do you have like particular MSAs you guys invest in, or what drives your market selection?
Yeah, so we've identified Texas, Florida, even Georgia, and Virginia as our primary markets. So 3 out of the 4 partners at Fairwinds Capital are all originally based out of Virginia Beach area. So Virginia was the primary focus. Since then, one of them has moved through his Navy career to Florida. So we've definitely got that market under our target sites. We've seen the growth in Texas overall, whether it be Houston, San Antonio, anywhere else. It's just the market's growing, rent rates are growing, the population's growing, jobs are coming in from all these tech giants. So we're just seeing a lot of growth. So we've identified Texas. We've got a few hundred units in Texas already. And so, yeah, those are the top 4 that we're looking at. But we also have a property in Maryland, which is the USNA, which is U.S. Naval Academy Alumni Association. So 3 of my partners are all either ex or current Navy members. And so that's a pretty close to home investment for them and all of us, just to be able to offer the Alumni Association a place where they have a triple net lease in place. And then eventually when they do move out of there, we'll be able to go in and convert that and change the business plan completely to say now it's going to be a event hosting space or a bed and breakfast space or something that's the Navy themed event hosting location. And then we're working with the city governor, working with city officials, working with the local sort of commercial associations to make sure that everybody's on board. We bring as much traffic there as possible. So we're constantly looking at adding value in any which way we can to whatever locations make the most sense.
Got it. Is there any kind of a minimum size of an asset you guys look for?
Yeah, so we typically aim for at least 100 plus units. We feel like that's sort of the sweet spot where we can have on-site management and see potential for growth and scale to be able to say, all right, if we're going to do landscaping, or if we're going to do restriping the whole parking lot, at least we have that many more units where the cost gets divided across. And if the same roof can cover 48 units per building versus 5, right, it's just the cost per unit then goes down, even though the dollar amounts goes high. Then it's easier to then bring the rental rates up and to say, okay, here now we can show profits and show what value we've added a little bit easier across that many more units. And the risk is diversified. If 5 tenants leave, it's a 5% vacancy versus 5 out of a 50 unit building where it's double,
Yeah. I know those numbers. That's for sure. So with respects to investors, is there a minimum investment that you require?
It's deal specific. If we have, I know many other guests have spoken about the 506B versus 506C syndications and SEC exemptions and stuff, but overall, it depends on what kind of investment strategy we're going after. It depends on what the size of the asset is, the raise is, and so it's been anywhere from 20,000 to 50,000 so far, and it may go up to 100,000, 250,000 in the future. Who knows? But it's just it all sort of grows with your investor base and how much faith and trust people have in you and your business plan and your ability to deliver. So it gets easier to raise higher amounts per person as you've done more and more syndications and more full cycle deals.
Got it. And you mentioned that you participated in, I think it was 7 as a limited partner, and now you're as a general partner. How many deals have you seen go full cycle?
As a limited partner, 1 so far. As a general partner, a couple of them so far.
Okay, so your general partner, you've been able to turn those pretty fast. What?
Yeah, I think we were just trying to leverage the market the way it was, right? If you bought right, we added value, we turned some units, and we listed it right away, just to gauge the market. And then the offers came in higher than we expected, so it just made way more sense to return our investors' capital, return 40-something% IRR to the investors, and go do more deals rather than just continue to go through our business plan, even though we could see it was adding value. It just was more favorable to return the money and get a higher IRR to our investors sooner.
And were you able, or what was the hold time on those, the ones that you turned really quick?
Less, I'd say within 2 years.
Oh, so perfect. You made you got the long-term capital gains, and
Yes.
no, it's perfect. I was thinking for a minute, like maybe you got in there and
6
a couple
months
months later,
later,
it's like, yeah. I've seen some, it's funny, as an insurance broker, I've had clients that have insured it, and they've introduced me to the buyer. We get it insured. Next thing you know, they're selling. I'm like, wow, so it's just the market dynamics have been pretty crazy here as of late.
I think
Although,
it's all changing now, especially
yeah, no, I was gonna say
today.
it's
No longer
yeah,
the case.
recording in September of 22, things are changing, as they say. So let's talk about that. You mentioned the members on your team. We've talked a little bit about some of the capital, the market you're in. What do you have? What's your sense of where things are going, given all that's in play with interest rates and just the kind of the status of the market?
I think it's all going to be in a cascading effect. If people, let's say, bought in 2019 or 2020 with bridge debt that was going to expire in 2 years or 3 years, and their plan was to be at a pretty high valuation as the market was continuing to go up, cap rates were continuing to compress, and the interest rates would stay low, those operators and those teams are in for the biggest shock, because now valuations have at least stabilized, if not already started going down in most markets. Interest rates have gone double of what they were before when they got into these debt structures. So their loan assumptions on the refinances, loan to value ratios, actual money cash out they were going to get and return to their investors, or sale prices, has all changed so drastically that I think those operators are unfortunately in for the biggest rough spot, to now be in the spot in their business plan to say, okay, well, we're ready to refinance. Let's go out and find some good long-term financing and hold this property. And now all of a sudden they're coming back with, instead of the 3 to 4% rate they were expecting, now they're hearing 6 to 7% rates. That definitely throws their business plan in for a loop. Their valuation was supposed to be, let's say, 20 million on the refinance, but now it's all of a sudden hitting 16 million because cap rates have, expanded again, the rates have gone up. So I think those people are going to hurt the most. And so over the next 6 to 12 months, you're going to see a lot of those properties hit the market to say, okay, well, let's just get out of it as soon as we can without having to refinance and hold it with having to put more money down on a refinance rather than getting money out. And then I think people who acquired this year, I mean, even we've acquired properties this year, if you got into it with bridge debt or at least 3 years of interest only and extension options built in, I think you're going to be able to write out most of this, because I don't see this going bad for 5 to 7 years continually from now. I feel like there's going to be a dip for a couple of years, and I think it's going to come back up. So there is that risk potential as well, but I think it's a lower risk if you acquired this year to then be able to ride out the next couple of years with interest only rates or long-term financing. If you were able to get it, that's kind of the best place you could be in.
Yeah, I get the debt challenges just based on interest rates and stuff. What are your thoughts on just the demand for housing and rent? Do you have any kind of opinion on that, or?
I think the markets where the demographic changed for the better, where the job growth happened, where tech industry showed up, and where there was already a strong demand that just continued to grow through COVID, those markets I feel like are going to continue to do the same. I don't think that you're going to all of a sudden see negative rent growth or negative population growth in those markets just because rent went up or interest rates went up. I feel like the single family housing may get impacted way more than multifamily, but the rents, because if people are not able to afford that same house they were able to afford 6 months ago with the lower interest rate, and they didn't buy, or they were priced out of the market because the rate was so low but the price was so high, now even though the price has stabilized and it's not continue to rise, the rates are going up, and so they are not able to afford that higher mortgage even though the prices stay the same. And so those guys have no option but to go into a rental situation. So I think the rental demand, even if the rent rate slows down or stabilizes, I don't think we're going to see negative rent growth. And I think that markets with strong sort of metrics for population and job growth and such are going to stay steady and not lose a lot of valuation just based on the fact that, oh, well, rates are going up, so all of a sudden values go down. I think the rent rates are going to stay steady and continue to grow in most of these markets. The secondary, tertiary markets in some states definitely, I think, are going to get more impacted because a lot fewer people want to be there in a market like this. They want to stay closer. Okay, people are going back to work, people are going back to their offices, so they have to go back to the central business districts and bigger MSAs to be able to commute more easily, which is different than what it was a year and a half ago when everybody was going out into the boonies, getting big lots, big homes, low rent rates, and enjoying the time with their families in home. Now that people are going back to the offices and going back to their work, I feel like they have to come back to that central business district area and say, all right, we're gonna pay the rent because we need to go to the office, and it's just not worth it to drive 2.5 hours each way every day to achieve that goal. So that's my outlook on what's happening now.
Certainly makes sense, and I think certainly the traffic patterns and just I think some sort of a flex work is, I think, probably here, whether or not to how many days people are going to the office to do the work. But clearly, I think that there's convenience, and there's a recognition of or a lot of the people are able to do the work remotely, but it's still, there's a sense of need to be accessible at the headquarters of the office or however that is, and
some human interaction during the day as well. Just
yeah. No, there's definitely that, and I think Zoom fatigue is definitely real. I mean, we're talking on Zoom now, but if we could be in person, that would be even better.
Exactly.
But the convenience of clicking a button as opposed to driving or flying down to San Francisco and meeting you up, yeah, makes a lot of sense. But that's cool. So with your deals that you have run full cycle, did the investors, or what percentage of your investors said, what's next?
I think most of them actually came back and said, "What's next?"
Okay.
Because it's all about building trust and
Right.
showing the proof in the pudding. So if you're able to deliver or beat the promises you had and clearly identified, like all of our investor updates clearly said, listen, we are not some amazing operators that just had this planned forever, and we delivered 48% IRR even though we told you 18, because that was always the way to go, and we know how to do this every single time. We clearly said, listen, the market was in our favor. We definitely were able to beat and more than double what we said we would do because the market was favorable. Don't expect us on every return on every transaction, because it's just not possible. But you've seen the way we operate, you've seen our communication, you've seen our business plan execution, you've seen our photos and videos come across showing you exactly what we're doing, what stage we're in, and how we manage our properties. So if you want to trust us and continue to invest with us, here's the next opportunity. So that's kind of what it took. Even though it was a shorter term hold, it still allowed them to get a full view of our process, our underwriting, our business plan execution strategies, and just seeing how we operate as a team.
No, makes sense. And speaking of next deal, do you have anything in the works right now? Do you have any offers out there, or are you guys just kind of laying low right now, waiting to see how the market plays out?
We have offers out there. We're constantly looking, and sometimes we change our business strategy to say, okay, well, rather than being lead sponsors, maybe we can be co-sponsors with other teams that have a bigger investor base, a bigger net worth, a bigger assets under management, and they have gotten a considerably larger deal under contract, and they're looking for co-sponsors to be able to bring investors to the table, to bring asset management experience to the table, investor relations, any of those key components that it takes to operate a business plan. We're looking for those opportunities as well. We've identified a few. We're underwriting today, tomorrow, all the time, and constantly looking at new deals. We've just adjusted what we think the cap rate needs to be on as-is financials. We've just adjusted what we think the refinance interest rates are going to be, what the interest rates are going to look like when we actually close in 2 to 3 months from whenever we get under contract. So we're just adjusting our underwriting to be even more conservative than what we were already doing, just to accommodate the higher risk of the rates, the LTCs. The number of lenders out there has gone down. It's not that the same number of lenders are just adjusting their rates. The number of lenders out there has gone down. They're just not willing to take the additional risk to say, all right, well, we'll just continue the business plan and keep raising rates and we're good to go. Some of these lenders out there got so used to valuations just going up over the last 3 years consistently that when they see this slow down and drop, they've just said, you know what, let's just pause, let's readjust our strategy, let's figure out what we really want to be able to offer, and then they may come back to the table. But I've seen that on the private lending side and on the commercial lending side.
No, it is interesting when when there's change in the marketplace, how things adjust, and what you think will happen, and those people you didn't even consider, those vendors you didn't consider as potentially not being available. And I think a lot of it's just it's kind of common in any situation when there's change. You don't know which ends up or where it's going, kind of thing.
Yeah.
Kind of lay back a little bit and see where it settles. Because what could be, what could have been a great deal 6 months ago right now would be a scary deal right now. Given some of the financing stuff. And I think that, that, one thing I do know about the real estate market is that there's an opportunity to make money in all markets. It's just a matter of, buying right is kind of the first thing. And I think that's probably one of the biggest stumbling blocks we have right now is you have sellers that are still thinking that, it's
It's March
early
right now.
Yeah, March of 22 or September of 21 or, whatever. And the reality is that as the money gets more expensive, the only thing that can change the return to the investors is a price adjustment. And that's that's kind of the market doing its thing. So it'll be interesting. And I think that, the thing that's interesting, and you kind of touched on a little bit about some of the people that are probably going to be facing, a need to exit, is that, when you have multiple investors gathered together, there's, people want out. And, a lot of times that's what causes the thing to undo, or you have to sell kind of thing. So
Yeah.
there will be transactions, there will be money made, there'll be money probably lost. But it will go forward. So that's good.
I think what we do to
So,
mitigate all that risk is that we've also implemented other strategies to say, okay, well, we may get into leveraging some of our units that are in our properties that we own and manage to become medium-term rentals for hospitals in the neighborhood, right? Like we'll work with our on-site management and on-site maintenance, but we'll bring in a third-party manager that will have the relationships with the nurse associations or the staffing agencies or insurance agencies where they need to house residents that are displaced or have a claim. And then we'll allow them to sort of come in and use our units while still paying us the rent we need, rather than relying solely on just long-term tenants. And to say, okay, well, we still maintained our NOI or grew it because now we're getting more money than market rent for these types of units, while still maintaining our employees on site, still getting the same returns for our investors or better returns, and lowering our risk because these entities will have a better chance of making sure they pay the rent versus individuals who may lose their jobs or may get displaced for some other reason and not be able to pay. So, or just choose not to pay, which is what happened a lot through COVID. So it's just, I think it's being flexible, being agile, and being able to shift your mindset to say, well, if this is not the business plan, let's just see what else works within the framework of what we already have to maintain our NOIs and maintain our returns to our investors.
no, makes sense. Speaking of risk, Jaspreet, by day, I'm an insurance broker, and I work with my clients to assess risk and determine what to do with the risk. And if we could, I'd like to shift gears here for a second. I'd like to ask you a little bit about risk. When I'm working with my clients, there's about 3 strategies we typically consider. We look to see first if we can avoid the risk. Then if we can't avoid it, we look to see if there's a way we can minimize the risk. And when we cannot avoid nor minimize the risk, then we look to see if we can transfer the risk. And that's what an insurance policy is. And as such, I like to ask my guests if they can look at their own situation. Could be clients, investors, the interest rates, political influences, however you identify what you consider to be the biggest risk. And for clarification, again, while I'm an insurance broker, I'm not necessarily looking for an insurance related answer.
Mm-hmm.
And so if you're willing, I'd like to ask you, Jaspreet Baveja, what is the biggest risk?
Oh man, I think shifting market trends is the biggest risk, because you never know exactly when it's going to start. You could be in the middle of a transaction when it hits you the hardest, and that makes you lose a deal because the market shift changed the valuation, the market shift changed the loan the lender was willing to give you, the market shift changed the rent rates you were expecting to put in your underwriting. And so it's the overall market, because whether the market is changing because of interest rates or geopolitical or any natural risk like Hurricane Ian that we have now, anything that changes the market to shift, I think, is the biggest risk, because that is something that is not entirely in your control. And like you said, it's not easy. If you have an insurance claim, sure, it's easy to transfer risk to that insurance company and say, all right, well, that's what we got you for, let's file a claim. But if you have a deal that's going south because the property was worth 25 million when you put the offer in for 25 million, and now the market shifted because the rent rates slowed down and the interest rates went up, and the biggest job provider that was in the market in that particular area just decided to up and leave, like Apple decides to leave San Jose for all those, for some reason, that's going to be a big market shift that you as an operator or as an investor or anything have no control over. And so that's going to automatically shift all of your underwriting, all of your projections of returns. And so I think the biggest risk is the market shift, whatever the cause may be.
No, I think that's well put, especially in today's environment. It's definitely reflective of what's going on and kind of where we're sitting. So
Yeah.
I like it. Hey, Jaspreet, where can the listeners go if they'd like to learn more or connect with you?
So our company, Fairwinds Capital Investments, the website is FWC, Fairwinds Capital Investments.com. And you can find out more about me, any of my partners, any of our assets under management. And there's a button there to contact us, fill out a form, and yeah, we'll be in touch.
Awesome. Jaspreet, I can't say thanks enough for taking the time to talk today. I've enjoyed it, learned a lot, and look forward to doing it again soon.
Same here. Thank you so much for having me, man.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CRE PN Radio.